presenter is alumnus Steve Kampschmidt. Steve, after graduating from RIT with an undergraduate degree in business management, decided to take advantage of the fast-track MBA offering RIT provided. Steve focused on finance and economics during his pursuit of his master's degree before entering the workforce in 2009. Upon graduation, he pursued a career in enterprise holdings, one of the largest rental car operations in the world. After having risen through the ranks at enterprise and eventually managing one of their Newark Airport brands, Steve opted to pursue his true passion, which was in the banking and finance industry. Steve spent time within management at Bank of America before making the leap to start his own advisory practice with Merrill Lynch. Steve now works on a team of advisors that specialize in developing customized, goal-based financial plans and investment solutions for his clients and their families. A proud Dumble alumnus of RIT, please welcome Steve Kampschmidt. Steve, we're thrilled to have you with us today. Our audience is all yours.
Thank you so much, Cindy. I really appreciate it. And wanted to say good afternoon first to everyone, and good morning if anyone's joining us further west from the East Coast. And again, thank you for everyone in attendance, to Cindy and to RIT as well for providing me the opportunity to go through this presentation with you today. Initially, I just want to give kind of a brief overview of the presentation before we get into the details. In terms of what to expect, the title kind of says, for the most part, everything there. It's going to be investing basics. We will be covering things like asset allocation, diversification, periodic review, breakdown of asset classes, and then more importantly, and what maybe isn't described within the title itself, is understanding the formation of a financial plan, what to look for, things like life priorities, specific goals that you might have, and creating a vision for your wealth. And then that all boils down to something we call goals-based wealth management. So we will go into a little bit more detail even in terms of creating that financial plan. So with that being said, we can go ahead and get started. So there's three pillars of smart investing, as you can see here. And a lot of people at this point have heard about asset allocation, diversification, but because this is kind of an introduction to this, there may be some of you who have not. So we're going to go through a little bit on each one of these pillars to break down exactly what that is. So asset allocation being really the true first pillar, and it's how you are choosing your assets depending upon maybe what your time horizon is or where you are currently within your life. So in asset allocation, they include a variety of different stocks or equities, bond positions or fixed income. You can have alternative investments, and then there's also cash and cash equivalents. So, and in terms of how those percentages breaks down will determine how risky you are or conservative you are. And many times you'll see the risk spectrum go from a conservative up to moderate conservative. There's a moderate level, moderately aggressive, and then an aggressive level of investing. So those are the most well-known percentages and breakdown of what asset allocation looks like. And as you go up that aggressive spectrum, you're going to increase your amount of stocks or equities as well as potentially alternative investments. As you drift farther down towards the conservative level, that is where you're going to increase your level of fixed income or bonds, and even to the point where you may just be in cash equivalents if you're really just trying to preserve and protect as much of your principal as possible. So within asset allocation, there's also diversification. So in each of those various stocks, bonds, alternative investments, there's an increasing amount of diversification that you can have within those. And then there is the periodic review that is, of course, once you've designed your portfolio, you're going to perform a periodic checkup, whether it's quarterly, semi-annually, annually. It's really dependent upon if you're managing things on your own individually or perhaps you are working with a financial advisor or planner. That periodic review will be dependent upon what your individual situation may look like. So this is the slide that then breaks down the asset allocation. So you can see kind of what I discussed before. There is the cash, equity, fixed income, and alternative investments. of the four components that make up asset allocation, and you will then see within each one of these that there is further breakdown. So within equity positions, there's all different types of equities. So you can have common stock positions, there's mutual funds, something that has really broken onto the scene in the past couple of decades especially has been exchange-traded funds. These are very low-cost, passive style of investments where they can track various indexes or perhaps sectors within the economy, and they're becoming ever-increasing in popularity. And then there's obviously a number of other things that for the purpose of this presentation, we're not going to go into the details of things like American depository receipts or closed-end funds. That might be something for a potential future presentation. And then within fixed income and alternatives, there's also a different list of things within those. So fixed income, you will have corporate bonds, corporate debt. There's also closed-end funds. There's emerging market debt for international countries that are currently developing and are coming up. Those are emerging markets. You will have municipal bonds that can be tax-free depending upon what type of municipal bond that you are purchasing. There's also treasuries that are provided by the government. And then within alternative investments, you have hedge funds, there are managed futures, something called TIPS, Treasury Inflation-Protected Securities, commodities, things that are going to be more real, precious metals, oil, harder assets, and there's real estate and private equity as well. So these are the various components within this asset allocation breakdown. And as you begin to become more and more involved with investing and more comfortable, you can become exposed to all these different types of investments that can have various risks, different returns, of course, depending upon what you're utilizing. And as long as you're having a healthy mix and a healthy diversification, that way you're not over-concentrating on anything. That's one of the most important concepts behind diversification. So you're not over-concentrated. So why is it important? Just briefly mentioned, of course, there's various levels of risk and reward, but it helps balance your goals and time horizon with your risk tolerance. So those things, if we look at them individually, goals, time horizon, and risk tolerance, let's talk about time horizon first. So don't know everyone who's on this call necessarily, but it could range. We may have recent graduates or even individuals who are still within college all the way up to current retirees. And within that spectrum, everyone is going to have a different time horizon within their various assets. So if you have a much shorter time horizon, if you have a particular goal that might be coming up very soon, so say maybe someone who is graduated not too long ago, they may be getting close to the point where they're interested in purchasing a home. And that is a shorter term goal at that point. So if you're acquiring assets, it may be more intelligent to be a little bit more conservative with those types of assets and the investing that you're doing, because you may have to use those assets for down payment in the very near future. If it's the assets that could be within an employer-based plan, a lot of people, 401ks have, of course, become increasingly familiar with everyone, and they're very common within the workforce at this point in time. 403bs also, depending upon what sector you might be in. But within those, you're going to have those employer-based plans where they may have a longer time horizon, especially if you are just beginning your career or you're still early on within your career. You're going to have an extended time horizon, potentially 10, 15, 20 plus years, where you can talk about having an asset allocation mix, which is a little more aggressive because you have that longer time horizon to potentially suffer through a market correction and wait for the return to come back. And then there's risk tolerance. And risk tolerance is completely upon the individual. It's heavily dependent upon how you feel. Something that I will do oftentimes is initially when meeting with a prospect, I might show them a graph which can show various levels of downturn, whether it be 10%, 20%, 30%, and then make it real by suggesting a number depending upon their assets. So if they have, for reference, $100,000, how are they going to feel if all of a sudden within 2 months from now from becoming a client, are they going to feel if it's only $60,000 to $70,000? And if that really gives them a great deal of concern, then it's a way of having a conversation to figure out what your potential risk tolerance could be. And it's important. And even if you do have a longer time horizon and you have specific goals in mind, if you have a more conservative risk tolerance versus more of an aggressive tolerance, then that might outweigh those goals and time horizon just because of how you feel and how you might want to preserve your principal that you've built up thus far. Let's move on to the next slide. Within those asset classes, again, there's going to be this increasing diversification I was mentioning before. So you can kind of go through a few of these here. Geography, of course, is whether or not you're investing domestically or internationally. And you might be investing within developed international markets or within emerging markets, like I mentioned earlier on in the presentation. There is sector and type. Various sectors is healthcare, financial, information technology. There is a host of different sectors within these asset classes, which you can then, of course, invest within. Size and style, that is something you might find, and you may find ETFs or mutual funds that are titled with a certain size and style. So that can be large cap, big cap, small cap stocks. And within those large cap or large capitalization, that's going to be your bigger companies, your Fortune 500 type companies that are much larger. You'll have middle cap and then smaller cap, which is, of course, smaller companies that are just coming about. So that will be within your size and style. And then the style portion of that's going to be value versus growth. So value will be companies that are going to be a little bit more conservative potentially. You may not have as much growth potential in terms of the price of the stock itself or of the company. But they may be a little bit more conservative, but you may be able to increase an income stream if they are more value-based versus more growth-oriented. Growth-oriented, of course, they might want to maintain more of their cash because they're looking to grow the company as a whole. And then there's liquidity and credit quality and maturity. Liquidity is going to be how liquid your investment is. So there may be some investments, especially within alternatives, where you might have to tie up your cash for a longer period of time. Also things, you might have heard things called like annuities, where those can also have what's called a lockup period or a surrender charge, where if you attempt to pull those assets out, you're going to potentially risk your principal. So they may not be as liquid as purchasing a money market fund or even an individual stock that you can actively trade on the market, which can be more liquid. And then credit quality and maturity, there is various levels of quality from highly rated and graded, whether it's corporate bonds or municipal bonds, and the length of maturity would be, whether they're short term, maybe only a 3-month or 1-year maturity, all the way up to a 30-year government treasury that could be available to you. So there's varying lengths of the maturity as well within this diversification. Diversification is important. The chart that you're looking at right now is really going into that size and style component that I was discussing before. And if you look towards the top right of the chart, there is the green box there for 2016. Just want to try and quickly go through this for everyone. That would be small cap value. The next box down, the red box, is mid cap value. The blue is large cap value. And then the DP section where it's yellow is a diversified portfolio, which would maintain, of course, a combination of all of these. And then there's small cap growth, mid cap growth, and large cap growth all the way at the bottom right of the chart. So this is part of diversification specifically within size and style, but you can see as you begin to diversify your portfolio and you don't concentrate too much in one position, you're going to have less of an up and down as the markets go through their different turns. So that's why this increasing importance of diversification. And you'll see this now. Something I did want to bring up and talk about is asset allocation and diversification is becoming increasingly simpler to obtain because we have a lot of companies and these exchange-traded funds that are available to individuals that will have a significant amount of holdings within them that can, and even within, if we talk about a 401k or a 403b, you might have what's called a target date fund. A target date fund, they have a specific year in mind when a proposed retirement would occur. So say you have, for example, a 2050 target date fund, and you're invested in that, it's assuming that you're going to retire in the year 2050. And so, given it's year 2019, that would leave you 31 years until retirement. So initially, when you first go into this target date fund, it's going to be a lot more aggressive. You're going to be on that asset allocation spectrum with a lot more stocks and equities and maybe a fewer percentage or a lesser percentage of fixed income or bonds and cash. And as you approach that target date, 2050, that fund is going to automatically start converting the percentages of stocks into bonds and potentially into cash, depending upon what the manager opts to do, so that you don't necessarily have to take care of things on your own. It's going to do it for you. And so the introduction of these types of funds, especially within employer plans, is really phenomenal. It is. A lot of times if individuals might be left to their own vices, it can be a lot more difficult to figure out your own diversification and ensuring that you aren't overly concentrated in whether it's maybe just domestic stocks or international or small cap that tends to be a little riskier. So these target date funds and asset allocation type funds and models that are being provided now are extremely beneficial. Move on. And other considerations that you need to keep in mind while investing, things that aren't necessarily a part of asset allocation or diversification, there's some market factors. And I meant to say earlier on in the presentation, something this presentation will not be is a 2019 outlook or where we are currently in the markets. There has been some increased volatility, of course, and I'm bringing this up now because these are some of the considerations that you have to have when it comes to investing. So more recently, within the past year, in 2018, volatility has reemerged, and there is liquidity concerns. Talked a little bit about that earlier, how long your assets might be tied up, currency exposure, whether or not the dollar is strong or if it's weakening, and how it relates to other currencies throughout the world. So there may be currency exposure depending upon how you're invested. Inflation risks. More recently, we have had our Federal Reserve has risen their interest rates recently so that they could try to counteract inflation concerns. So all of these factors are very important and they're considerations that have to be made when you're putting together a portfolio for yourself. And depending upon those goals, your risk tolerance, and your time horizon, these are additional considerations that need to be made when you're formulating that portfolio. Periodic review, understanding when you need to. Now, many times what we'll do is, at least within my own practices, we will outline when we're going to perform periodic reviews prior to entering in a relationship, and that can be as frequently as monthly even, monthly, quarterly, semi-annually, or potentially annually, depending upon the needs of the individual and their family. So, but there can also be other triggers that will cause a potential review to happen. So that can be market forces, things that we discussed just on the previous slide, future economic outlook, and then even more important, I think, is changing personal situation. This is something where if you have a major life event, whether it's the birth of a child, if you get married or divorced, if you're nearing retirement, the purchase of a home, all these different factors, perhaps you're looking for a new position or you're in the marketplace for obtaining a new job currently. These are all instances where your personal situation has changed, and it's important to have a review done at that point to make sure that your investments are aligned with your current goals and outlook and strategy for the future. So those are the reasons for this slide. Let's go to the next. Okay. So we've touched on a number of the basics of investing in and of itself and selecting securities and various assets. Now what I consider even more important is the planning phase. And before you ever end up actually selecting your various investments and where you're going to put your money to work, understanding your life and your current goals is kind of the bedrock of forming a financial plan. So this is something that Merrill Lynch had created a while back. They put together these life priorities with centered in on your finances, which is currently in the middle. So there's your family, giving, philanthropic, philanthropic efforts, your work, your career, home, leisure, and health. So all of these different life priorities, and they may change, and various priorities become bumped up and increasing importance depending upon where you are within your life at any given time. And within the center of all these various life priorities are going to be your finances. And this breaks it down a little bit further. So how do your life priorities and then goals translate into an investment portfolio? So going into each one of the priorities, giving, there is lots of different, there are various vehicles where you can attempt to give if you are philanthropically inclined, where there's also trust that you can form within your own family. There's something called a donor-advised fund, things that you can take advantage of in terms of giving for philanthropic efforts. Within your work, there's going to be various priorities you might have within your workplace. Of course, leisure, if you're more focused on a point in your career, a point in your life where you want to increase the amount of travel or the vacations that you might have, is going to be health concerns at some point potentially within your life where you're going to have to dedicate a certain amount of assets or money towards this particular priority, and there's going to be various ways where you can do that. There's long-term care planning. And then, of course, family is at the center, of course, of everything. So determining how you might want to set up estate planning needs, if you're giving various gifting amounts or establishing trust for your own family, funding vehicles like a 529 for children for educational purposes. All these different priorities are going to be discussed initially when you're forming that financial plan to determine what specific goals you have. So, and then as you're putting together and defining those goals, we'll talk again about risk tolerance, the time horizon within those goals, and then the target amount that you will need to fund that particular goal. So if you did have a particular lifestyle need, if you're going to be entering retirement, you might want to have a particular nest egg available depending upon what your lifestyle needs will be. Now, there is no one-size-fits-all, especially when it comes to retirement. Depending upon an individual's situation and what their needs may be, there may be differing amounts. And figuring out what that target amount is, you won't know until you really start to formulate your financial plan, understand your budget, and what your budget might look like within your retirement. And then after you've gone through these various life priorities and defined the various goals that you might have depending upon where you are within your life, that's when putting together an overall portfolio comes into place. And as you accumulate wealth, there's going to be increasing complexity where you may have access to various types of vehicles and various assets where that increasing diversification happens, and there's just more and more needs that might rise about as wealth begins or continues to be accumulated throughout careers. And yeah, this is part of the vision planning. So this is understanding what you want your wealth to do for you. So you may have those very short-term goals, and in kind of ascending order, you might plan out a particular portfolio or a strategy for your various assets for your shorter-term goals. There will be midterm, and then you're going to have a longer-term goal, which could be for retirement or for estate planning. So understanding the various aspects of wealth and how you're devising that portfolio is important, and making sure that you're always coming back and having those reviews to ensure that your vision for your wealth is continued and things are adapted and changed as that vision might switch depending upon potential life events that occur. So to kind of summarize everything that we've now discussed before we end up entering into a Q&A session, and I wanted to leave a sufficient amount of time for question and answer. This is a goals-based approach. This is something that we use within our own practice, and it's incredibly important. And even if you're not working with a financial planner or an advisor, utilizing this type of approach is critical. You don't just want to, if you have a certain lump sum of money, pick the hottest thing out there. I would not suggest that. I would first, anytime you begin to think about how you're going to invest your wealth or the assets that you do have available to you, you need to understand where you are in your current life first, and then look at what your goals are for the future. So this is especially important for everyone, but depending upon if you have shorter term goals that are coming up relatively soon, is very critical for those. And those shorter-term goals, again, depending upon where you are in your life, could be that purchase of a home, funding a college education, or even retirement. And you need to make sure that if you have a shorter-term goal, that you might want to divert a portion of assets in order to make sure that you protect principal for those things. Again, it's going to be heavily dependent upon your own level of tolerance, time horizon, and that target amount that you're needing before putting together that portfolio strategy. And then, of course, performing those periodic reviews, staying on track, making sure that you have a process, not just attempting to do things here and there, or if you're finding yourself all of a sudden, oh man, I forgot to check that, or I haven't looked at my 401k portfolio in a long time. If you're doing that without a kind of systematic approach, then I would certainly suggest to you figure out a way to put a plan in place where whether you have an Outlook reminder or some kind of calendar invite where you're ensuring that on a periodic basis you're looking at these things, gaining an understanding, again, whether or not you're doing it on your own or with a planner, just making sure you have some kind of systematic approach in place to ensure you're reviewing these things, because your own personal situation may change, market forces change, and your goals are going to change. So you need to ensure that your portfolio is adapted and modified to go along with it. So I believe that is everything within the slides that I have for the presentation today. You'll find my contact information, of course, is on this slide. I believe the presentation is going to be provided to everyone as well. I would certainly encourage you to ask questions now and then later also. So with that being said, Cindy, I'd be happy to kind of open things up back to you. And we've hit the 12:30 mark. Go ahead and open up for some questions.
Yes, thank you, Steve, for that presentation. A question's come in from Diana. She would like to know, I'd like to invest my kid's savings account. Do you have any reduced risk suggestions for doing so?
So I'll say this now, and I'm glad we got this question initially. I would be happy to answer this type of question. I would be more comfortable, of course, doing it on an individual level. So if anyone does have these types of questions for their individual situation, I would be more than happy to answer them. If I will do the best I can. If you want to end up, I just wanted to address that first, but if you don't mind repeating the question for me, Cindy, I'll try and answer it as best I can now, but I do need to, of course, be careful too. If I'm not working with somebody on an individual level, there are things within my industry where I have to be careful about providing advice if we're not currently actually working in an established relationship. But go ahead and ask me the question again, Cindy, and I'll see what kind of advice I might be able to provide.
Okay, great. Thank you, and that's understandable. So Diana is interested in knowing a little bit more about how she might go about investing her kids' savings accounts. She's looking for opportunities that are reduced risk suggestions. So maybe in a broad stroke, you might be able to answer that.
Sure. So there's, and I think I mentioned this during the presentation, there are 529 accounts. There's also something called a Coverdell account, but more and more people are utilizing 529s, especially now, where you're actually able to use 529s on a broader scale, whereas before it was largely for higher educational purposes. But now there's been some additional changes within the tax law this prior year, where you can now utilize these assets for earlier education as well. Now, in terms of tax benefits, I should also mention I'm not a certified public accountant, but in terms of tax benefits with utilizing these 529s, federally you may gain from using them, but sometimes the jury's kind of still out within various states, because some states, of course, you can get a deduction when you're placing funds into a 529, while other states you cannot. So you just have to be careful, and I would encourage seeking out a tax consultant as well when deciding whether or not you may want to fund a 529. And now funding this 529, you mentioned becoming more conservative. Any type of, whether it's within a 529, I mean, if you're also using a UTMA or UGMA account, these are transfer to minor type savings accounts. Those can be extremely conservative, where they're just basically invested in cash, and an FDIC insured deposit. And for those, an FDIC insured deposit is something that's insured by the federal government, typically up to $250,000. But if it's held within cash within a banking environment or an FDIC insured bank, that would be considered very conservative. Now, there's absolutely nothing that provides you no risk. Even putting you've heard people probably mention the saying, putting money under their mattress, that of course carries a risk in and of itself. So regardless of whether or not you hold in cash, stocks, bonds, everything has a certain degree of risk. There is nothing that has no risk whatsoever. There's just different types and varying levels. So, but to try and answer your question, within a 529, you can have increasingly conservative portfolios or funds that should be available to you within those 529s. And if I didn't already, just 529s, just briefly, are tax-advantaged children's education type savings accounts. And I'll stop there just without going too much more deep into it to allow for other questions. But I hope that helps a little bit with the question that you did have.
Okay, thank you, Steve. Diana, if you have additional questions, Steve's email is on the slide, so feel free. Maybe I shouldn't say feel free to send Steve an email, but his email is there, so hopefully, Steve, if she reaches out, you guys can chat further. So let's see. Jeffrey had a question. I've got to scroll up. My wife and I's annual income is over the limit for Roth contributions. Any good ideas for an alternative backdoor Roth? Question mark?
Sure. So, and this is very, very important. And I'll kind of take this as an opportunity to explain more about Roth and traditional accounts for those who may not be aware. Traditional retirement accounts are going to be pre-taxed funds that you're placing into a retirement account. And then both accounts will have tax-deferred growth while they're within these types of accounts, they're growing tax-deferred. But a traditional account or a traditional IRA eventually will be taxed upon the distributions of the account. Roth account is different, where Roth account is going to be post-tax funds, but what is so beneficial about them is they are still tax-deferred, just the way a traditional account is. But when you end up taking distributions from a Roth retirement account, there are no taxes. And they are a phenomenal tool. I would encourage everyone to, if you haven't already investigated utilizing a Roth, look into it, and depending upon, again, your personal situation, you may or may not be able to use one. There are also Roth options that are becoming increasingly available within 401k plans as well and 403bs. So just know that if you have that option, or if maybe that option has become available to you recently, I would encourage looking into it and determining, and whether or not you do this on your own again or with a planner, finding whether or not this could work to your benefit. So wanted to first just give that quick breakdown of the different types. And to answer your question, there is ways to do a backdoor Roth conversion. And what they're asking is, once you reach a certain income limit, and this is dependent upon your tax bracket. So if you're a single filer or married filing jointly, you're going to have various levels. And I believe that they've recently changed for 2019, but it's in the range of $190,000 to $200,000 for married filing jointly. So if you've reached that threshold or you're passing that threshold, you may or may not be able to perform this backdoor Roth conversion. And I say may not, even though you could, but you have to be careful. And again, this is something where I have to be careful because I'm not necessarily a CPA, and I would encourage talking to a tax consultant. But I can tell you that if you don't have a traditional IRA already, a personal traditional IRA, and this is outside of an employer-based account, because there are employer accounts like a 401k which are separate from this. But if you don't have a traditional IRA, it can be a little easier to perform a backdoor Roth conversion because you don't have what's called a basis already. And this may be getting a little more complex, and maybe too complex because this is considered investing basics. But if you don't already have a traditional IRA, it may very well be easier for you to make what's called a non-deductible contribution into a traditional IRA, and then you should allow these assets to sit for a period of time before processing what's called that Roth conversion. And you can do this without experiencing any kind of tax detriment if you don't have assets already within a traditional IRA. So it can get far more complicated, however, if you do already have a traditional IRA, a personal traditional IRA, where you're then looking to perform this backdoor Roth conversion, and you can get affected within your taxes more. So that's when, again, I'll probably reiterate this a number of times, but I would encourage seeking out also a tax professional to make sure that if you're doing a backdoor Roth conversion, you're doing it with all taxes being considered. So I hope that kind of helps answer your question around that backdoor Roth conversion.
Thank you, Steve. I hope it does too. Now let's move on to Raul's question. How do we go about selecting a good quality target data retirement fund?
Sure. So that will be dependent, and most are kind of on a 5-year basis. You'll see ones that are 2025 all the way out to now 2060 or beyond potentially, with 5-year intervals. So it's going to be highly dependent upon when you plan to retire, and that really shouldn't be the only consideration too. That is what many people will use in terms of determining which one they want to, but just know that within each one of those different target date funds, one of the potential downfalls, and I already did mention, I think they're a phenomenal tool because they give you an increasing level of diversification and kind of set up an asset allocation for you. But one downfall is if you have a different level of risk tolerance or perhaps a time horizon that maybe it is different or maybe it changes. So if you've set up a particular target date fund where it's 30, 35 years from now, perhaps you have a life event. Maybe you inherit assets or you obtain assets in some other capacity where it might not make sense to then use that same type of target date fund because you might want to preserve your principal more or become more aggressive if you have enough assets. So it is highly dependent, but if you're looking at it in the most simple manner, then yes, you're going to think, hey, if you want to retire at age 60, or if you think you'll have the ability to retire at age 60, 65, whatever that number might be, you just have to go out and select that particular target date. So again, for round numbers, let's say if you're 40 years of age and you want to retire at age 65, then you're going to probably want to look at a 2055 target date fund on the most simple capacity. That's giving you, that would be a 2045. So it's giving you an additional 25 years before you're potentially reaching retirement. Happy to discuss in more detail because so many of these types of questions are going to be really dependent upon your individual situation.
Yep, that makes sense. Vinod's question is, in terms of saving and investing, what are some of the changes from last year to this year? I'm hoping that makes sense. I'm reading it verbatim. Yeah, so this is one of those where I'm going to be careful because the marketplace has changed. Certainly I'll talk in again kind of generalities, but we've gone through a longer bull run. If you're looking at any kind of analyst or financial analyst, if you turn on the news, you've probably heard in the most recent 12 months how we've been in this longer term bull run since we had kind of a larger downturn and correction back in 08, 09, and this is one of these market factors where you're having to look at things and identify how you might want to adjust your portfolio tactically. I can tell you that me personally, I'm not a fan of making drastic choices or drastic swings and changes within portfolios, depending upon, again, what your individual situation is, and if you absolutely have to. But I feel like it's a bit of a cop-out by saying this, but it really is highly dependent upon your situation because you can't just look at market factors alone and have that be the sole reason for adapting your portfolio or changing your investments. You have to, more importantly, look at what's going on in your life right now, what your priorities are, and what you're saving for.
That's what you need to look at first, and then look at market factors and market considerations and what's going on a year-to-year basis.
Excellent. Thank you. Hope that helps, Vinod. Evan's question is, how are financial planners advisors paid? For instance, how do I know if it is worth having a financial advisor, whether it is a good investment or not?
Yeah, and that's a very important question. And when you're looking for a financial planner or a financial advisor, there are going to be different ways where planners and advisors can be paid. So I will tell you kind of the different things that you might end up encountering. So kind of the financial advisor of old, or we might call them stockbrokers, a lot of the things that they do, and this is still true to this day, they might charge a commission on the sale of a particular investment, or if you're purchasing a mutual fund, for instance, they may charge a particular commission up front, or an ongoing trail commission was what it might be called. So it's just depending upon who you work with, there might be different ways in which they're compensated. So you have to look at the value, of course, that's being returned to you first and foremost, and be careful. And there's probably no right or wrong answer when it comes to like a percentage. And there are those who get charged or charge commissions, and then there are those who are going to charge what's called an asset under management fee or an advisory fee. I can tell you that's largely how I operate. I operate largely on an advisory basis, where it's a percentage of the assets that you might be having managed for you. And those percentages can range anywhere from as low as maybe 0.5% up to 1.5%, or maybe a little more. It's kind of dependent upon the individual, what your needs are, how large your wealth might be, and I would encourage anyone, because there is variability within our industry, depending upon who you're working with, you need to ask them, and they need to be transparent. Anyone, if you're working with any advisor, if you don't feel their pricing is transparent and you don't understand how they're being paid, I would caution you to, at minimum, seek out an additional reference point and speak with another person, just so you can get some of that extra reference and have something to compare it to. Because if they're not being transparent with exactly how they're being compensated and paid, then there could be cause for concern. And, if maybe not, but I would just be leery of working with anyone who isn't able to clearly break down to you exactly how they're being paid. By and large, it's either kind of on a commission type basis or an advisory approach, where they're typically will be charging a percentage of the assets that they are directly managing.
Thank you, Steve. Hope that helps, Evan. A question came in from Mike. Is there a recommended target split of Roth versus pre-tax retirement savings so that you could withdraw some Roth savings, parentheses, no tax, during a first stage partial retirement, and then parentheses, still working but at a lower paying job, and save the pre-tax for when fully retired? Minimal other income, so low tax bracket is in parentheses. I hope that makes sense, Steve. I could read it again.
Yeah. No, it's okay. I think it's a little bit more individualized and complicated question, but that's okay. And I like this question because I think it is important to have a balance. So regardless of what area and age you are in your life now, again, this is not across the board for everyone, so I would encourage everyone to kind of just be careful with this, and I'd be happy to talk with anyone on an individual level. But I think I can tell you that having a balance, I absolutely advocate. And unless you're much further down the road and you're in a place where you're in a much larger income tax bracket, it may or may not at that point make sense. But there are so many factors, what future tax rates might be, and how much your current spending level is right now, and what it might be in retirement. If you're in a much lower tax bracket in retirement, that's going to obviously change what mix and what balance you might want to have. But to attempt to answer your question, I think having a little bit of both, or hopefully even a lot of bit of both, can be very beneficial, because like you're mentioning, it's going to give you some of that additional flexibility. And if you're in that first stage, yes, you'll be able to draw down assets. And whether you're pulling from non-qualified accounts And non-qualified accounts, again, or I might not have mentioned this, non-qualified account is going to be a non-retirement vehicle. So if you have a regular taxable brokerage account versus a qualified account, which would be a retirement savings account, like a Roth IRA or a traditional IRA. If you have an even mix between all of these, you're going to have an increasing level of flexibility. And depending upon what the tax rates are, what capital gains rates are, if you do have a non-qualified portfolio as well, these are all going to be factors in determining how you draw down your assets, especially when you're in maybe a partial retirement situation like you're in now, or approaching that full retirement. And this is probably one of the most critical areas for anyone is when you're getting closer and closer to retirement and understanding the drawdown of assets. If anyone hasn't researched bucketing strategies, I would encourage you to write that down and look into that as well. A bucketing approach or a bucketing strategy is essentially you have different buckets where maybe a first bucket is your shortest time horizon or a safer bucket. You're going to have a second bucket that's maybe middle time horizon, 3 to 5 years or maybe a little bit longer, and then you're going to have a longer term time horizon. And this equips those who are approaching retirement or within retirement with the ability to look at assets in a certain way where you have more peace of mind, because you're ensuring that you're refilling bucket one, which is going to provide for your ongoing retirement expenses, and then you'll have your second bucket and third bucket, which will be devised of your various assets, whether they are in qualified or non-qualified accounts, and those are going to be replenishing that first bucket. And then once you get to the point where you're reaching age 70, when you reach age 70 or 70 and a half really, and the following year after, you have to take your initial RMD, what's called a required minimum distribution. This is where traditional IRAs, you will have to start withdrawing funds from your IRA at that point, and you're required to take these minimum distributions. And a Roth account, you don't actually have to take RMDs once you reach age 70 and a half. So again, I'm giving a very detailed answer. It's a type of detailed question. But there are a lot of factors, and I wanted to try and hit on as much as possible because depending upon the various assets that you have, it might make more sense to use your non-qualified accounts, and if you do have assets in that bucket, because you're going to get a better tax rate on selling those investments. So it's highly dependent upon what assets you have, but I hope that does kind of help with a portion of that question.
Great. Thank you, Steve. The questions come in from Eric. How often should I be meeting with my financial advisor to review my portfolios? For example, only during life-changing events every 5 to 10 years, I'm thinking, during market changes, or should I be meeting with my financial advisor on an annual basis?
I can tell you about what I do, Eric. I mean, our team, we require, at least and within Merrill Lynch as a whole, we require annual reviews, and I think that might be kind of a standard for a lot of firms out there is a required annual review, but then it depends upon the person and their situation again. So I have clients I work with where I talk on a monthly basis, especially in recent times, and I have clients that don't want to be bothered. They might, not want to meet until the annual review. I would encourage, I think, an annual review at minimum. I think 5 to 10 year time frame is definitely too long. There's a lot of things that can happen in 5 to 10 years. A lot of things can happen within 1 year. So I think an annual review at minimum, if you're working with an advisor or planner, is important to do. But then, more frequently than that, it depends. Again, it could be as often as a monthly get-together or call, or semi-annually or quarterly. So it's going to be dependent upon how much time you have, and then how just what you have going on within your life. So it really is dependent. But at minimum, I would encourage an annual review. Yeah.
All right. Thank you. A question came in from Holly. I don't remember the term, but how do we determine if the advisor is guaranteeing that he or she is operating in the client's best interest and not the financial advisor's?
So that's the fiduciary. That is a fiduciary term. And yeah. So working with the fiduciary is can be very important, and that's something I'm completing my CFP certification. I'm sitting for the exam at least this year. And so you'll see that term, especially within those who are CFP board approved financial advisors, the term fiduciary, and yes, that is where the advisor is acting in your best interest. They are not acting in the client's or within the advisor's best interest. So, and you'll see that all advisors can be fiduciaries, I guess. It gets a little tricky and to determine, because there could even be a situation where someone who's working on an advisory position and charging a particular percentage, well, maybe if they're charging a percentage and you're all in cash, is that really acting in the client's best interest by charging them this percentage fee when they're sitting all in cash or they have a higher concentrated position? So it's difficult to ask, but the term you're searching for is are you operating as a fiduciary? And I would encourage anyone to ask that question too when you're beginning talks with a financial planner and advisor, to make sure that they are looking out for your best interests and what kinds of products they're selling or offering you, because it's very possible that they might have a high commission tagged to that particular vehicle, and then there could be some conflict of interest.
Okay, that makes sense. Earlier in the slide, you talked about goals and life events. When you work with clients, how do you help them prioritize goals? Is it purely based on timing, or are there some other criteria that you utilize?
Conversation-based. Typically, when I sit down with an initial prospect and potential client, I just gain an understanding for their life, where they are. I ask about their family. Do they have children? Where are their parents currently right now? There's so many different factors. Where are they in their career right now? What are their upcoming purchases? Do you have any upcoming potential purchases right now? What does your current retirement vision look like? There's a variety of questions that I'll end up asking to kind of just gain an understanding, but I think keeping it conversational and having a discussion with the prospect is what's so critically important, because there isn't a one-size-fits-all. So determining what those goals are and what your priorities might be before crafting that strategy or portfolio solution, just engaging in a complete discussion and setting yourself up with plenty of time to do so. You don't want to be rushed when determining what your priorities and goals are. You kind of want to think it out, and that's a lot of that. Even beforehand, I will encourage people before they meet with me, start thinking about those things. And some of those questions I just brought up, I might ask those before we ever actually sit down face to face, so that they've kind of formulated some of their ideas and really thought about what their vision and current goals are.
Okay, and question on market stability. It's been pretty up and down dramatically in the last weeks, months. We presume that you're advising clients to sort of ride the wave, ride the storm, but how are you talking to your clients about what's been happening in the markets these days?
Sure, and this is definitely one of those where I kind of mentioned it's I can't give a concrete answer here, and I apologize. Again, I feel like this is a cop-out, and I would love to answer this question on an individual basis, and I am happy to do so in that capacity. But it's totally dependent. Just speaking again and taking a step back and trying to speak in generalities, if you have a longer time horizon, you have a more aggressive risk tolerance, then in those situations, yes, I'm going to tell a person, ride the wave. You have a longer time horizon. Long-term investors, people who stick with it, who don't get bothered by the sways in the market, are going to perform better. But there are also those who have nearer-term goals. And if you're nearing retirement, or perhaps you're interested in purchasing a home this year because interest rates are still relatively low, but they might be on the up, it's highly dependent upon your personal situation, and you may want to take tactical or make tactical shifts within your investments depending upon the type of assets and if whether or not they're held in qualified and non-qualified accounts. So there are an unlimited amount of factors to look at here, but I hope some of that general guidance with understanding or assuming certain risk tolerance or time horizon, yes. I think having a longer time horizon, understanding that the markets go up and down, and over the long term, they go up for longer periods of time, and then on shorter periods of time, they go down. So that's just, if you look at a chart historically, that's kind of how it works with the stock market as a whole. So I hope that, again, I hope that kind of helps as much as I could there. Okay,
thanks. One last question. It's a follow-up question. Mike had asked previously about Roth IRAs, pre-tax and tax, et cetera. The latest question is, so if retiring, say, in 2030, should I have only some savings in a 2030 retirement fund and part maybe in a 2040 fund and maybe some in a 2050 fund? Since retirement can last 20-plus years, so to not to get too conservative with all the money as 2030 approaches, any recommended percentage breakdown for this type of strategy?
Yeah, so that one definitely, because I feel like if I answer that, I don't want anyone to, I have to know the entire situation, so there's not really any safe way for me to answer that particular question, so I'm going to kind of have to, unfortunately, say, hey, if you want me to answer that one, reach out to me. I would love to have a discussion with anyone who has that particular of a question, because it sounds like you might also be looking at your retirement plan or your employer retirement plan, and there's something called selling away within our industry where I can't really answer that question because that's something that could be swayed or considered selling away within my industry. So just reach out to me if you'd like. I'd be happy to attempt answering that question if I'm even able to on an individual capacity. But kind of unfortunately, I don't want to delve into that.
Understood. So, but is what Mike described an example of this bucketing strategy you talked about earlier? Or no? He's asking that.
Yeah, kind of. The bucket strategy that is more for once you're actually within retirement or very close to retirement. That's when I'll typically use that type of bucketing strategy. If you're within a few years of retirement, if you're 10+ year time horizon, then you still have a relatively longer kind of horizon there. But if you're really less than 5 years, or especially within the coming 2 to 3 years, that's where that bucketing strategy, especially once you're in retirement, it's increasingly important because you have to ensure that you don't have an income anymore. So once you don't have an income anymore, or you might have a reduced income if you're in partial retirement, you're having to create that additional stream of income somehow. So, and you're using that bucketing strategy where you have your longer term bucket that flows into the middle term bucket and then into your shorter term bucket. That's where that bucketing strategy is so important. So it's more so for those who are very close or actually within retirement, but not to say that you can't use a type of bucketing strategy even if you have a much longer time horizon.
All right, great. We are out of time. So, Steve, thank you very much for your presentation today. We appreciate it. And audience, thanks to you for joining us. If you have any additional questions, you can email them to ritalum@rit.edu or tweet them to @RIT_alumni with the hashtag #MeRIT, and we will forward them over to Steve.